Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. And our guest for this week's show is investment expert Joel Friedland. Now, Joel is the founder and CEO of Brit Properties, an investment firm focused on industrial real estate investments in the greater Chicago area. Now, one of the unique aspects of Joel's business that we'll dive into today is that he uses zero leverage when acquiring assets, which is not something most of us are all that accustomed to. So we'll dive in deeper to that. Joel also has a 42-year track record in the industrial real estate field. He co-founded Epic Savage Realty Partners back in 1991, where he oversaw hiring and mentoring 60 industrial real estate professionals, many of whom became his partners. His group sold the firm to an international real estate company in 2014, and Joel started Brit Properties. And so without further ado, I'd like to welcome Joel to the show. Joel, how you doing today?
Great, Kevin. Great to see you.
Yeah, no, excited to have you here and excited to learn more about you and your businesses. So let's before we dive into it, what I'd love to do, I gave you kind of just a high level overview. I would love for you in your own words to give us a little, more information about you, yourself, your background, and a little bit more about what it is you do.
Sure. So I started out as a kid entrepreneur. When I was in my early teens, I started a landscape business, and I literally went door to door canvassing my neighbors, convincing them to let us cut their lawn. And I ended up getting 70 lawns in one weekend.
Wow.
Just
Yeah,
I
that's
was
pretty impressive.
compulsively going from one house to another to another. And so I knew I could do sales. And so when I graduated from Michigan in Ann Arbor, I decided I wanted to be in real estate. I knew it. And I went to work for a family that I knew. I didn't know them well. They're not my family. They had 80 industrial buildings. And I didn't really know what industrial was, but I figured I'll learn. So it was 1981. They had 10 vacant buildings. Interest rates were 17% that year. And companies were just not leasing space. So I did what I did as a kid, and I went door to door canvassing in industrial parks to find tenants for the empty buildings owned by the Podolsky family, the people that I work for. And I had three mentors there, and every day I was asking questions. It's all about, in my opinion, being curious, learning, and I learned everything I could about industrial, which I love. And 42 years later, I'm still doing industrial. And I'm still close with Steve Podolsky, my original mentor from 42 years ago.
No, that's fantastic. I appreciate the background there, and that's just backing up a little bit. Speaking to kind of your start, with the landscaping. A lot of folks, just starting your entrepreneurial journey, whether it's your own business or you're getting started in a sales role or some other type of profession. Most folks, are more concerned about not having enough business or getting, too many no's. Not many, have the concern or ultimately have the what became a new problem of yours is having too many yeses, right?
Yeah.
that's
Did you ever
that's
see that commercial? There are these two guys in an elevator and they win business. They're wearing suits and they made a presentation and they're riding down in the elevator. And one looks at the other. He says, "Okay, now that we've got the business, what are we going to do?"
that's right.
Right?
That's a
That's
good
been my
problem.
problem.
It's
Yeah,
a
my
good problem
problem
to
has
have.
been I've been a really solid relationship builder and cold
Yeah.
caller. So I worked for the Podolskis as a real estate broker. I had my license,
Hmm.
and I did, no joke, 500 leases and sales in the first 10 years.
Wow.
It was an average of like 50 a year.
That's
And these
impressive.
were all industrial. These were all manufacturing companies that were occupying buildings, a lot of multi-tenant buildings. I was the agent for them. And I learned all about how businesses work and what to look for in a company and making sure that the tenants had solid financial statements and could pay the rent.
Hmm.
And I just learned about all the different kinds of companies that occupy industrial buildings,
Yeah.
manufacturers of every product, distributors of every product, service companies. And I became a bit of an expert in 10 years. And then I decided, looking at the Podolskis, I figured out that they were very wealthy and they had become wealthy by being owners, not brokers. So I filled like a pigeonhole role for them as an agent while they were buying and building their portfolio. And it took me a while. I wasn't that smart to figure it out right away. I wish I had gone into the ownership business earlier. But after 10 years, I went to the Podolskis and I said, I want to start buying and I want to syndicate. And they said, we'll put up some of the money if you do that. We'll put up a third of whatever you need, but you have to go out and get the other investors.
Mhm.
So I went and found a property, $560,000, 14,000 square foot warehouse. And we leased it after putting the deal together. I got investors for $20,000 each. One of the things they said to me is, how much are you putting in? I said, well, if you're putting in 20,000, I'll put in 20,000. And I had a couple dozen investors and we leased it and then said, hey, this worked. Let's go do another one. So then we went to a $2.7 million deal. And after that, I've done, let's say, I think 98 other deals because I think we just did our 100th acquisition of industrial buildings.
Mhm.
And it's
Fantastic.
been a really interesting ride, lots of ups and downs.
Let's unpack that very first one. That kind of laid the foundation. You know, it's interesting because you correct me if I'm wrong. You had been a transactional broker for about 10 years before doing your first acquisition, correct?
Yeah,
Is
I
that an
didn't know how
accurate
to get
statement?
started. I was sort of
Okay.
stuck.
Yeah, but you knew the fundamentals of the business, right? Like you knew how to find good quality tenants. You knew how to identify problem properties, or what the problems were, and ultimately how to address them, and how to make maybe an underperforming property perform better. Like you knew all the aspects of the business. But with all that being said, when it comes time to actually write the check on the buying side, right, actually stepping into the role of a buyer and an owner of a property and taking on that completely different responsibility, right? Because on a transactional basis, your responsibility is pretty much done with once you get paid on a property. Once you move on to the next one, right? And in broker's shoes. But being an owner, it's just it's a completely different world. And no matter how much that very first deal always, you've got a lot of trepidation. So talk to me about that first deal. What excited you about it? Did you consider walking away at any point in time? And just, I guess, from the basics of what was the opportunity that you saw that you knew that you could
Sure.
make money from?
So industrial is all about the geometry, and I'm sure that the mobile home business is also. The geometry is really important. Every industrial building is just a box. They're big boxes, they're small boxes. They go from 10,000 square feet up to hundreds of thousands of square feet. And then the other geometry issue is how tall the ceiling is, and then how many loading docks there are for getting product in and out of the building, and parking. And so I knew what tenants liked because I had done so much leasing as an agent. And so the first building, this 14,000-foot building, the reason I liked it was because of the size. There's a lot of tenants. In Chicago, we have 1.5 billion square feet of industrial. We've got 16,000 buildings. And so that's a big market. It's one of the top 3 in the country. And I figured it out. I figured out that tenants like high ceilings, at least one dock for every 1,000 square feet, and a lot of parking, easily maneuverable for trucks to get in and out of the docks. And I figured out that size and those amenities were perfect. So that's why the first deal was that 14,000-foot building. And I didn't have enough money to do the whole deal. And I wanted to do it all cash. I didn't want a mortgage. I wanted to go low risk. And I didn't know where to start. So I went to Steve and Milt Podolsky and I said, guys, what do I do here? How do I do my first deal? And they said, well, you're going to need a lawyer. I saw your interview with Gene, is it Trowbridge, the attorney, the securities attorney?
Correct.
I found a securities attorney and he said, oh, well, you need to do a private placement memorandum. If you're going to have more than 3 investors, you're breaking the securities laws if you don't put a book together. So I hired him to put a book together. And I couldn't afford that much. So I said, how much does it cost? He said, well, it'll be at least 20 grand. I said, I'm going to do a bunch of these. How about if you do them all for 5,000? And I promise you that you'll at least have 10 deals. He said, okay. So we put together a PPM, and a PPM is both a sales piece and also a disclosure piece. And there are certain requirements that you have to have in there. So I was very salesy in the first 10 pages about the deal, and then all the risk factors, the conflicts of interest. And I gave the book to each investor. And you know what they said? We don't care what the book says. We just trust you. In some cases, they were people whose lawns I used to cut. In some cases, they were clients from my being a real estate agent from those days. And the Podolskis put up 200,000, which was a third, roughly. And I felt like I was learning on the job. You know how it is when you do your first deal. And I made a lot of mistakes. I didn't exactly know what to say. I kind of winged it because I'm pretty good at sales, and it worked out. And I started reading the book. It was about 68 pages long. I still have it. And you have to know every single paragraph in those books, because if an investor asks, how does this work? What's the promote, the carried interest? What's the preferred return? When do I get my money back? How long is this deal going to be owned by all of us? You got to know the answers. You can't just say, well, I think maybe. The first time you say maybe, you lose them. So I answered all the questions, right or wrong, and I learned. And it was a great experience.
No, fantastic. And just one other question before we move on from that first deal. The when you acquired it, was it a vacant building at that time, or I think you had mentioned that you got a lease kind of put in place prior to closing, but just want to better understand the the basics of that deal.
Yeah, I'll tell you what happened. It was a vacant building, and as an agent, because I was working for the Podolskis as an agent, I put it on the market, and I had two showings the first day after I started advertising it. The first one was a guy who made baby products, baby gates, safety gates, and he was a distributor of baby strollers and things like that. And the other company was in the building supply business. And I agreed to a deal with the guy in the building supply business with a handshake to lease him the building. And the guy in the baby gate business called me back and he says, I have to have this building. It's a must. It's the perfect building for me. And I had to tell him no, which is really hard. When two companies want the same building, it's extremely difficult to let one down. So I went out I knew the guy loved scotch. He was a drinker of scotch. So I went to the store and I bought the little airplane sized scotch bottles. I bought him a case. And I brought it to where his business was currently located as a peace offering, because I couldn't lease him the building. And he has become a lifelong friend and a client and an investor. And we've been together. And when I come to Florida, I have dinner with him. He's the greatest guy, but I bumped him. He was bumped.
Yeah, it happens.
Yeah.
But that is a tough conversation to have. It surely is. Yeah. And I promise only one last question on this first deal, and then we'll definitely move on.
Yeah.
Why was the property vacant when you acquired it? Was it just being mismanaged or misoperated by the current owner?
No, newly built.
Okay, understood.
Newly built.
That makes sense. Okay.
Yeah, we got our hands on a brand new building. Got
it. Well, fantastic. Well, would love to understand, the evolution of your business model. There's some context that I shared in the introduction related to you don't use leverage whatsoever and use no debt in your acquisitions. And a lot of that is a result of 2008, and would love to learn a little bit more about what your business looked like leading into 2008, what type of negative impacts, the recession had, and ultimately how it changed your business as it looks today.
Sure. So up until 2008, I had acquired and syndicated about 75 buildings already. And we had sold about 25, so we had 50 remaining. And they were all over. We were actually in Florida. We had 2 buildings. We had a building in New York. We had one in Ohio. And then the rest were in Chicago. And what happened was I lost my way. I had a partner who was 10 years younger, a guy named Dave. We called him Big Dave. And Big Dave loved debt. And as we were doing more and more deals, and we were safe as could be because we were low leverage or no leverage, Dave said, think how much more money our investors and we will make if we start putting debt on these things. So by the time 2008 came around, we had 7 banks, and we actually had 50 loans on 50 properties. We didn't have a single all cash property anymore. And in 2008, things just fell apart for so many people. And in my case, I had 200 investors, and it looked to me like I was going to go bankrupt with the rest of the people that I know that were going down the tubes, because we had some vacancies. We had 10 vacancies, just like my old mentor did in 1981. And it's impossible to sustain a downturn when the banks are requiring pay downs like they are today. They're requiring equity infusions, and that's what they wanted then. And we didn't have the money, and we had vacancies. So the portfolio was really in trouble, and I was mentally in trouble. I went into a clinical depression because I was so devastated, and I felt so ashamed that I had brought all these people that I cared so much about as investors into these deals. I was so devastated that literally medication wasn't helping me. I was like a psychiatrist's dream. He could try every medication to see if it would work on my severe depression that I just was really, I wasn't eating. I was on that couch. I couldn't come off the couch, couldn't get up, couldn't go to meetings. I mean, I was just a wreck. And my friends were concerned, and my family was concerned. And I started meditating, and I started going to counseling. And then I figured out the only way to come out of a depression is to work. So I went back to work, and I actually saved the portfolio from going into bankruptcy, and everything that we had, with 2 buildings as exceptions that we gave back to banks, 48 buildings, we saved the day by persevering. It was miserable. Mm-hmm. And I really never, ever wanted to feel that way again. The pain of that downturn and what I allowed it to do to me is the reason that I became an evangelist for, at least in my case, in my investor's case, buying with either no debt or an absolute maximum of a 30% loan to value ratio. And we've repositioned our portfolio so that our average loan to value, because we still have some old loans from old syndications, we're down to about 17% loan to value. And almost all of the recent ones have been all cash, no debt. I watched Dave Ramsey, and it's not the same thing, because he talks to people who don't have a lot of money and about how, yeah, you shouldn't buy the car. You know, okay, that's we're in a different position than that. But there was a guy named Coach Carson. I don't know if you've ever seen him. And he's got a podcast as well. And I was looking all over the internet for, if I do this thing with no debt, who else is doing that in the world? And I couldn't find anybody who was really doing sophisticated, large building syndications other than us. Mm-hmm. So I tested it out on some investors. I said, how do you think you'd feel about investing in an all cash deal? 1 out of every 3 says, are you out of your mind? That's stupid. I want a higher return. I want a riskier deal. I'm willing to take risk. But 2 out of 3 of my kind of people, which are very successful doctors, lawyers, accountants, owners of businesses, people who have sold companies for, you know, a big liquidity event, they like being safe. They like preservation.
Yeah. Yep.
So I actually started bringing together groups of investors to buy buildings with no debt. And it doesn't work for everybody. Most people, it's so much work to if you do a $3 million deal, you have to raise $3 million. As opposed to if you borrow 75%, you only have to raise $750,000. Mm-hmm. And again, when people say, how much are you putting in? It's got to be a percentage. It's got to be like 5 or 10%. So if we were doing deals where a $3 million purchase would require $750,000 of equity, and I was putting in 5%, that would be $37,000. If I'm doing a $3 million deal and I'm putting in 5%, you know, we're talking about 150,000. Everything is magnified in terms of trying to be safe, but having to do things that other people get off easy on.
Yeah, no, you're absolutely preaching to the choir. Maybe not the exact same overall investment philosophy as it relates to debt, but I had my own challenges, significant challenges during the Great Recession. Had a lot of banks breathing down my neck, and just went through some mentally challenging times, and ultimately found my way, found my path back. And it's interesting because I think my business has actually taken probably a very similar path to yours as far as evolving as a result of 2008. The stresses related to 2008, and it's made us just a much more conservative group today. My business partner Brian Spear, he was not in the real estate game in '08, and so him and I have always had a little bit of a push and pull to a certain degree, but ultimately, where our portfolio is at today, it's interesting because if you look back over the last 3 years when, debt was at an all-time low, cap rate compression was just, it was real, and properties were trading in every asset class was trading at record prices.
Sure.
And we were more net sellers over the last couple of years than we were net buyers. Our conservative offers would typically never make it to a final best round. We weren't as competitive buyers, we weren't as aggressive, and so while it felt like we had some anxiety and it felt like we might have been missing the boat over the last couple of years, it's always hard to kind of step back and take an outside perspective and looking in, saying, oh, it's okay if we just take our time a little bit, let everyone else feed into the buying frenzy, and we'll still be fine on the backside. Like a little bit of that FOMO, the fear of missing out, but we ultimately didn't succumb to that, and we were very conservative again over the last 3 years. And where we find ourselves today is in a really interesting spot. Our portfolio is in a great place. We're not, we're still making distributions. We haven't halted distributions. We're not making capital calls. We're not, falling into special servicing like a lot of folks are. Folks that literally just bought properties in the last couple of years are finding a lot of challenges that they're facing from a multitude of places. And then, across our portfolio, our average loan to value is about 50%, give or take. I think it's slightly less than that, but about 50%. But one could argue, as you stated, one could argue that we're not necessarily giving as high a return as what we could have to our investors over the last couple of years. We're not leveraging as much, but now I can promise you that the majority of our investors, even maybe the ones that voiced a little bit more aggressively that they want higher leverage points and want to push the returns, are now very happy that we didn't take that stance over the last couple of years. So it's interesting. I feel really good. I sleep really well at night right now, and I know a lot of other folks aren't. Like we're entering another very volatile time, not necessarily reminiscent of 2008, but in its own light, there's challenges that are taking place, and folks that are struggling. There's distressed assets that are already kind of finding their way to the marketplace, and we're seeing the stress cracks with our own eyes now. So anyway, just you made me reflect quite a bit back on my own little journey through 2008, and ultimately how it formed and helped form the business that I have today. So anyway, I appreciate you sharing, and I appreciate you being vulnerable and transparent, because it was real. It was not many people I knew that are successful today or were successful back then in real estate didn't come out of that with some bruises or many bruises, or some that just never ever reclaimed their business. They went out of business and found another path, another career path, another line of work. They were just
I have a
shied away from
slogan.
real estate.
I have a slogan. I send quarterly reports to my investors, and I just finished the drafts of the December ones for this quarter. And we send cash flow by ACH to the investors every quarter. And in the letter, it says a couple of my slogans are the new status symbol is staying power and being able to sleep at night.
I love it. I love it. I might steal an iteration of that from you. No,
it's all yours. You can have it.
No, it's important. I mean, it's important. And anyway, just it sounds like we're both in a great position today. And honestly, I think maybe not necessarily, you're much more in tune with industrial and whether or not there's any stress cracks. I mean, it's been one of the darling asset classes over the last decade, as has multifamily. But ultimately, there's I'm sure there's probably still some stress that might come out of this over the next couple of years that might create opportunity for you or create opportunity for those that are well capitalized and are able to move quickly. So, but
Yeah, I'm seeing it. I'm seeing it already. There are stress
okay,
cracks. Oh yeah,
yeah,
yeah. I'm very much in touch, even with my competitors, and sometimes I bring deals to them because we focus on Class B and C industrial buildings near O'Hare Airport and in the city. We try not to go too far out into the suburbs because the more you go out in Chicago, you can go east and you're in the lake, but if you go west, you're in farmland. And so these developers who have pension fund money are building these gigantic Class A buildings as far as the eye can see out on those empty farms. All they have to do is bring some water and sewer to the street, and they can build a monstrous warehouse and lease it to Amazon or to Wayfair or somebody. And we do these smaller buildings that are older buildings that are closer in where the population is a little more dense. And I figured out one really important thing about my business, which is that users consider a single tenant building to be a tool for their business when they buy it, not an investment. So our whole strategy, which is really different than anybody else's, is we buy a building, try to keep it as long as we can, but when the tenant leaves, and eventually they leave, even if they're there for 20 years, it comes on the market, we try to lease it. If we can't lease it, the exit strategy is selling it to someone in the neighborhood that manufactures products down the street. Because I'll give you an example. We have a building on Tripp Avenue in Chicago. By the way, that's the street that Walt Disney was born on, originally from Chicago. It's a 33,000 foot building, and it's occupied by a company that manufactures products, safety products for the welding industry. It's a very niche type of industry. And the tenant was thinking of leaving, and we, for a short time, had it on the market. As an investment, we bought it for $2.7 million. But the neighbor that wanted it told me, if you would sell me that building, I will way overpay. Just get it for me. Like, has anyone ever said that to you about one of your mobile home parks? Hey, if you sell this, I'll way overpay. So we figured out that the user sales strategy gives us somewhere between a 30 and 40% premium versus selling it on a cap rate to an investor. So interestingly, of the 100 buildings that we've owned, we currently have 20 remaining. And of the 80 that we've sold, all but 4 have been sold to users because of that strategy. Single tenant buildings. If somebody walks into a building and they're 3 doors away and they need to expand, rather than moving their whole place and consolidating the new need with the old building, they'll take a second building. We call it plant number 2. And if it's next door, it's even better, because then they can go back and forth. They can build like a hallway out of canvas, with some metal, and they can drive forklift trucks back and forth. It's amazing.
No, a very interesting strategy. Have you, on the flip side of that, have you ever gone down the path or considered, the opposite approach, was doing a sale leaseback with an owner user?
We've done that a lot.
Okay.
We bought a building in New York. They manufactured magnets, and we bought it for $3 million. And we made a 15-year lease with a company called Dexter Magnetic. It was in Hicksville, New York on Long Island, 42,000 feet. And 15 years later, Dexter moved out, and we sold it to a company that does medical test production. They make medical tests. And you can imagine with COVID what they went into. So they needed a building just at the time that Dexter Magnetic was leaving. And I called a broker, an industrial broker with a company called Newmark, this guy, Chuck. I said, Chuck, what do you think the building's worth over there? It's on Karen Lane. And he said, oh, I know that building. And I thought he was going to say 4 million. He said 6.5 to 7 million to a user. I said, no way. He said, watch me. I hired him. He brought 6 offers. It was unbelievable. Wow. And we sold it to the guy in the medical products business, and sold it for just under 7 million. And I couldn't believe it, but a user will pay a premium for a single tenant building as a tool for his business. There's nowhere else. There's so little available. The vacancy rate on single tenant small buildings is so low. And in fact, on the north side of the city, it's 0. It's a 0 vacancy factor.
What have you found to be the sweet spot in size, square footage wise?
We own a lot of 20,000 foot buildings. I'll take them all day. The companies are big enough that they have history. They've got solid revenue. They understand their business. I would say that if you could give me 120,000 foot buildings at a reasonable price, I'd buy all of them. I'd syndicate them all, and like that, boom. But it's really hard to find. We comb the market, and it's really hard to find deals.
Yeah. What's a reasonable price nowadays in your marketplace? I mean, what are you looking to pay per foot for something? Again, I guess what would be, again, classified as that reasonable price point? One that you can absolutely make money on.
So I used to buy them for $50 a square foot, and I thought that was a lot. That was back in the 1990s and early 2000s. And what happened was, right before COVID, they started to go up because the internet became such an important part of the economy. And then because of the supply chain problems, a lot of companies were moving back from China to manufacture onshore here, which created a lot more demand. And then the internet got even stronger because of COVID, and the properties have doubled in value since 2019. So what used to be, say, $60 is now 120 4 years later. And this bubble's going to pop. This is not, I'm seeing the cracks. It's been too good for too long. And I think the economy, at some point, there has to be a recession. The economy just doesn't grow to the sky. It's going to stop. And when it does, we're poised to go in and buy buildings. But right now, boy, it's tough. We only bought 4 buildings this whole year, and we'd love to buy 10 or 12.
What do you think will be the catalyst to make it pop, at least as it relates to your industry? Is it more, businesses going out of business, or is it debt maturities impacting the actual owner of the building itself? Combination of the two?
I don't think it'll be companies going out of business. The companies that are in our size space, they make it through. They figure out a way to make it through. A lot of them are family businesses or they're big corporations. We've had Maytag, AT&T, General Motors. We get a lot of big tenants, and then the local ones are family owned for generations. Like now the grandchildren run the business that grandpa started. They're not going to go out of business. That's not what I'm worried about. What I'm worried about is overbuilding of the really big ones, because they're being built speculatively with speculative money from pension funds and insurance companies. Developers get the money, they build. That's just how they work. They make fees. And if it doesn't work, they make fees. And if it does work, they make fees plus profits.
Sure.
So that's going to get overbuilt. And the other thing that I see that's going to happen is when companies do grow and they want to move to a new building, they're going to wait. So any new building that's being built, if there is a recession, that's every time we get in trouble. There's a recession and people just wait. They say, I'm on hold. And when they're on hold, eventually there are vacancies. And then the other problem is, because of what's going on in office, when one asset class in real estate goes down, the others follow. They may not follow right away, but they do, because real estate gets a black eye. So I see that it's possible that companies are going to vacate space to save money. They're not going to go out of business. But as the newspapers and you read all the local whatever they're called, these Connect Real Estate, I'm sure you get them, these online magazines that they're talking about how bad office is and how bad malls are, and it's just going to follow. It's like dominoes, and that's what's going to happen, and the values will go down. I am sure of it.
What do you think the what do you think the plan B is for you? Speaking to these large distribution centers that are being built out in less densely populated areas, that ultimately might find themselves in an overbuilt status. Like, what is a plan B for a large facility such as that if it's not distribution for
They're
Walmart,
screwed. They're
Amazon,
screwed.
Wayfair?
They're screwed.
One of the few companies that could truly occupy that much space.
Well, actually, there's a lot of companies that
Or,
occupy that kind of space. You'd be shocked. The kind of companies like what's the guy that makes those floor liners for cars? He's got ads on all the time. He makes floor liners. It's plastic stuff or
I know I've actually got some in my truck. I can't think of the name, but I
yeah.
know what you're referring to.
That guy's got 5 industrial buildings in the Chicago area. I think maybe even 6, and they are huge. Like they're hundreds of thousands of square feet where they're doing this plastic injection molding.
Mm-hmm.
There's a lot of manufacturers who occupy those really big spaces. And you name it, HVAC distributors, they need bulk because they have these gigantic air conditioners and heaters. They just need a lot of space. There's going to be vacancy. And when I worked for Milt Podolsky and Steve Podolsky in 1981, they had a building that was 300,000 square feet in a town called Alsip, south suburb of Chicago. It had been vacant for 2 years when I got there. And while I was there and the market was bad, it stayed vacant for another 2 years. So they had 4 years of death.
Wow.
And it's going to happen again. That's when once it gets overbuilt, if you run out of tenants, vacancy is the problem. And hopefully whoever owns those has deep enough pockets to be able to get through and pay the taxes and the insurance and the maintenance and the utilities, because that keeps coming.
That's a big nut to crack every month.
Yeah. I'm really pessimistic about what's going to happen next year.
Interesting. Yeah, no, I don't disagree with you. I mean, we're already seeing it in our industry to a certain degree, and we don't need to go down that rabbit hole. But again, the stress cracks are showing. We're all aware of that. The entire floor is cracked in the office sector, right? But the stress cracks are present in pretty much every other sector at this time. So, well, Joel, this has been a great conversation. I've really enjoyed having you here on the show. Well, I guess on a parting note here, talk to me about like your business over the next, call it 3 to 5 years. Give us your vision of what your business looks like, under the assumptions that we'll have some distress, some maybe that will turn to opportunities, acquisition opportunities, but just would love to hear your vision for your company over the next 3 to 5 years and what that looks like.
Yeah. So we are looking to buy this small industrial type of building under 30,000 square feet, ideally leased. We don't care if they're short-term leases, because if a tenant's manufacturing, they can't leave. They can't find new employees. That they'd have to train people if their folks left. And they have machines that might cost $1 million or $2 million or $3 million to move, where the rent's only $300,000 a year. They're going to put that decision off. So we're buying buildings that are leased with tenants that can't leave. We call them sticky tenants. And we're buying them all cash to the extent that we can. We did one deal with 30% debt. It was a $13 million deal, and I couldn't raise the whole 13 million. I only raised 9 million. We had to borrow 4. And so 4 million is that 30% that I'm allowed to borrow. And I've got an 8-person advisory board. I don't make a single move without them, and they're very conservative. They're part of my investment group. And we're going to find deals that those guys will accept, with tenants that are decent, that will probably stay, and just own long-term and collect. We try to get cash on cash return starting yield of 8%. We pay 2% a quarter to the investors, and they don't like the interruption of cash flow. So we've got to buy buildings where it's really steady and stable, where the tenants won't leave. And if they do, where we can have the staying power and sleep at night and figure out who to fill it back with. So that's our plan. Okay. We'd like to buy this year probably $40 million worth of investment deals. And it's hard. It's a very hard strategy to hit those kind of numbers.
Well, also buying on an 8% unlevered return. There's still a lot of liquidity out there looking for a home. I'm guessing that there's probably some pricing, seller pricing expectations have maybe adjusted a slight bit.
Yeah.
Would love maybe your input there, what that looks like. Has there been a major adjustment, a minor adjustment, no adjustment at all as far as seller expectations? And I guess how many stones do you have to overturn to find that needle in the haystack 8% unlevered deal?
Yeah. So in our market, we've got the 16,000 buildings. And of those buildings, the ones that work for us from a geometry and location standpoint, there's only a pool of 2,000 buildings. Mm-hmm. The other 14,000, I couldn't care less about. We're not going to go for them. That's for somebody else. So we follow those 2,000 buildings, and literally, no kidding, we look at 2,000 buildings every day to figure out which one might be coming available. We have one now that we're looking at. It's very funny. We used to own it, and we sold it to a company that makes the phones, the emergency phones for parking lots and universities, where you see the little blue light and you pick up the phone and go, help, help, someone's chasing me. That's what they make. It's called Talkaphone. We sold that building after owning it for a number of years, and we're buying it back from the person we sold it to, because it's a family and the owner died and his family wants to get rid of the building. They had sold the company to a private equity group. It's a great little company, great tenant. And that's an example of one. 3 months ago, it was worth probably 20% more than it is today. And I'm trying to explain to the family how the market's changed. And they said to me this morning, just take it, just do it. We want to get out. Okay. And I'm afraid that it might be a falling knife. It might be worth 10% less or 20% less sometime in the next year or two if bad things happen. But we've got the bridge of that lease with Talkaphone for 3.5 years, and they'll probably stay, and we're buying it all cash. So
that's it. Yeah.
That's the profile.
Yeah, no, I mean, if you're buying it all cash, there's no debt risk there, and if it's a what you might classify as an irreplaceable location, that's just it's got underlying just phenomenal fundamentals, and within its local marketplace, then really time will heal all wounds, right? I mean, really the only time it doesn't heal the wounds is if the debt knife slices too deep.
And it does. So in this case, we're doing probably a $25,000 minimum, because a lot of our people go into a bunch of deals. So if someone's got $200,000 to invest, I'd rather have them 8 times in 8 deals than one time for $200,000 in one deal. And I tell them that. So we'll have a lot of investors in this deal. We'll probably have 50 investors in it.
No, fantastic. Well, again, Joel, appreciate you coming to the show. For those that want to learn more about you and your business and your different offerings, where's the best place to track you down?
BritProperties.com. BRIT, 1 T in Brit.
Righty. Fantastic, guys. I'll put that in the show notes. And Joel, with that, that's all we have. So appreciate you coming on. And it's been a very enjoyable conversation. I've learned a ton, and look forward to catching up with you another time.
Thanks, Kevin.
Alrighty, guys. That's all we have for this week's show. So until we meet again next week, this is your host, Kevin Butt, wishing you huge success. Take care now.